All right. Thank you everyone for attending this month's market update webinar for the month of November 2024. Let's start with some disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale of any or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Please be sure to first consult with a qualified financial advisor and or tax professional before implementing any strategy discussed within the presentation. And of course, past performance is not a guarantee of future results. You can learn more on our disclosure page on our website. And throughout the webinar, please submit any questions you have in the Q&A using the Q&A button. Quick bio about myself. My name is Jeremy Eppley. I'm a certified financial planner, a certified private wealth advisor, accredited investment fiduciary, accredited portfolio management advisor, chartered retirement planning counselor, and I have my master's degree in financial planning. You can learn more about me on my LinkedIn. And Silverstone Financial is a fee-only fiduciary registered investment advisory firm. We provide comprehensive wealth management services, including financial planning, investment management, tax prep, estate planning, that kind of stuff. You can learn more about us on our website. So, of course, there's going to be one large news item that we'll talk about, but we'll save it for the end. We'll start with the more boring market updates. One change that you might notice if you come regularly is that I have dropped the Dow Jones on the list of my indices. I never very much liked the Dow Jones Industrial Average as an index. Its only value is it's very, very old, and you can compare some really some markets from like the early 1900s. But in general, there are better built indices with better rationale behind them and better rebalancing. I won't get too much into it, but I replaced it with an index that is near and dear to my heart, the S&P 500's GARP index, which stands for Growth at a Reasonable Price. It's a strategy that I use with clients in conjunction with some others to holistically have a diverse set of investment holdings. So it's not all in on GARP or all in on anything else, but I want to show it as an index each month so that you can see it ebb and flow. Here, it was the only US equity index of these four that had a positive return. When I get to the next slide, you'll see it for year to date, and it underperforms because most of the returns are generated by the Magnificent Seven, the seven largest stocks on the exchange, which the GARP filters out. It has maybe one or two of the seven instead of a very heavy concentration when you're looking at the mega cap companies or the S&P 500, which is very concentrated in those largest companies. With that out of the way, this month was interesting. We had some pullback. Generally, still the mega caps somewhat performed well, but others had a pullback. You can see Meta and Apple were the main ones that fell. The reasons why the mega caps underperformed was another one of the really, really large companies, Eli Lilly, which is a drug manufacturer right in the middle here, when it fell by 15%. So that really pulled on the S&P 500 and mega caps, even though NVIDIA was up another 10% for the year. Global ex-US underperformed. Aggregate bonds had some losses in total return. In a stance of total return, not just looking at prices or just interest. And gold, Bitcoin, crude oil performed a little bit better with that commodity skew. Inflation still a concern for until the Fed is done with this tightening. All right. Year to date, the main point I wanted to bring up here is you can see GARP underperforming the rest of the S&P 500 and mega caps. But again, most of the S&P 500 and mega cap gains are just from this NVIDIA holding up being up 200% year to date, which is a mind-boggling number, thinking that such a large company could be up 200% in 10 months. Difficult to wrap your head around. Quickly wanted to also show the daily chart. Nothing too special, it's up and to the right, but you see right here the U.S. election. Some of you might have attended tonight just because of the U.S. election and how the markets have been reacting. I think it was up, depending on which index you're referring to, like 2 to 4% just today because of Donald Trump's victory. Whether or not it is good or bad that he won falls in depending on your political opinions, but from the market's perspective, it seems to be a net positive because of this rally. It's hard to argue otherwise. I also like to show this graphic each month, which the outside circle shows historical returns of the S&P 500. It helps show the cyclicality and the seasonality of the market. So each month, the April, November, and December are the strongest months historically. December being the strongest. A lot of you might have heard of the Santa Claus rally, which definitely leads to a little bit stronger returns near the end of the year, versus September, August being the worst period of the year, seasonally at least. This year we saw that trend not being followed at all. It bucked to the trend. April, one of the best months, the best month in the first half of the year historically, seasonally. And it was the only month in the first half of the year that had a negative return. And then September, the market didn't care about September at all. It kept on pushing forward after running for 4 months prior to that. And then August, which was this past month, we finally had a little bit of a drawback. Now, will we continue to see a drawback? I don't know. It depends on this froth and this hype around Donald Trump being elected and the potential tax cuts or deregulation or whatever is causing market performance here. My gut is that excitement will probably stay until the end of the year. But again, the point of financial planning and investment management, the best returns is the best strategy for returns is to stay in the market, not time the market, consistently invest, not do anything crazy. So even if I'm wrong and there is a big sell-off for the rest of November and December, as long as you have a plan, have a strategy in place, that's what's most important. All right, so now that we got the boring market numbers out of the way, let's get into some notable events. Of course, I'll keep the election last, even though it technically didn't happen last month. But the 4 most interesting topics that happened last month that many of you honestly might not have picked up on, and they were at the beginning of the month, so if you did see it in your news feed, you might have forgotten about, was the port strike, which was really important. We talked a lot about it in September. It resolved itself, at least temporarily, on August 4th. The International Longshoremen Association, which is the union that is in contention with the USMX ownership group, which controls the ports. They reached a short-term deal that raised wages, again, a short-term, to reopen all the ports for 100 days. So that strike that was causing, or at least potentially going to cause lots of delays and shutdowns and then supply chain issues, that is not happening, at least yet. 100 days from now, on January 15th, that short-term deal will expire. That deal is meant to give them time to continue the negotiations without, throwing the U.S. economy and, well, the global economy into turmoil because of the strike. I don't know if 100 days is enough to resolve the differences because they were standing pretty far away from each other in terms of the deal negotiation. They definitely have a lot more to discuss. I know automation was the largest concern from the unions. They don't want their jobs replaced by robots. From a market efficiency standpoint, I don't know if that union position will be able to hold long term. Robots are coming for us all. So eventually, unless that is one of their deal breaking, no matter what, we're going to shut down the economy if you don't give us that. In writing, you'll never replace us with robots. There was a good chance that that is conceded by the union, or January 15th, we'll probably see some more headlines about the port strike restarting, and we'll bring all those news items to you February when we talk about the past month's events, if that does occur. All right, October 10th. If you don't follow finance news, I would guess this didn't break above the rest of the general pop culture news or whatever was popular on October 10th. But TD Bank, which is the 10th largest bank in the United States, they pleaded guilty to conspiring to fail to maintain anti-money laundering programs that comply with the Bank Secrecy Act. They also pled guilty to failing to file accurate currency transaction reports, and they pled guilty to laundering money. For someone that is in the finance industry who has taken different licensing exams and knows how much the regulators care about these sorts of anti-money laundering provisions and regulations, you don't want to mess with that. You definitely want to be very careful with making sure criminals aren't using your financial institution to launder money, to finance terrorist organizations, to break the law in any way, essentially. So this ended up being a pretty hefty fine. TD Bank agreed to pay $1.8 billion in penalties to resolve this investigation into the violations. The reason why it was so large, even for the 10th largest bank, $1.8 billion in penalties does actually hit the bottom line of that company. The only reason these violation or these penalties are so large is it happened over a decade of just continual failure. Based on the court documents, this is secondhand reporting, but between January 2014 and October 2023, TD Bank had long-term, pervasive, and systematic deficiencies in its U.S. anti-money laundering policies, procedures, and controls, and basically never appropriately remedied their mistakes. They just swept it under the rug and hoped it wouldn't be a problem. And according to the Justice Department, that led it to be the TD Bank to be very convenient for criminals to launder money through the bank. I didn't see any specific figure. I was curious about it on approximately how much money was laundered through the bank, but that probably will never be known because one of the reasons, the only way you would know that is if you had proper programs in place to catch them in the first place. Like, banks have so much transaction volume that if you aren't doing these reports that all transactions above $10,000 are reported to make sure that those are what the currency transaction reports are, to make sure that there isn't systematic problems with putting money in and withdrawing it and mixing it with other business activities to clean the money from illicit drug sales or whatever other criminal activity was going on. So for most of you, I'm sure that's somewhat of a boring event or news item, but it was really shocking, at least to me, being in finance and seeing the 10th largest bank, trillions of dollars of money, massive company having such a large failure to a very common and important regulatory requirement that all banks are held to. So very interesting to me. Another headline that probably didn't breach the threshold for most of your news feeds was that on October 17th, a man named Eric Council Jr., he's 25 years old in Athens, Alabama. He was arrested in connection with the hacking of the Securities and Exchange Commission's Twitter account, or X account now, that happened in January of this year, 2024. On that day in January, the hacker, at this point still alleged hacker, he posted a fake message from the chair of the SEC stating that the pending Bitcoin exchange traded funds, so ETF applications, had been approved before the SEC had actually approved them and released these messages. I think it was the day before, which there's an argument to be made. Well, one day difference in the announcement, is there really a big issue here? Essentially, that announcement caused Bitcoin, its price to spike by $1,000, and it constitutes market manipulation. And the point of this hack was for this hacker to be long this cryptocurrency and then manipulate the market with this fake news that eventually became real news the next day, but tried to manipulate the feelings of the participants in the market so that they could cash in on their holdings. Again, was it worth it? No, they could have just waited a day. That was probably the better thing the hacker should have done. But it was a huge embarrassment to the SEC that, again, this wasn't, the SEC is a huge regulatory body, first off. And second, this was the chair announcing it, and it was very formally written. There was no belief that this was a hack. So not only that they had the hack happen, then a few hours later, the chair had to post on again and make different press releases saying, no, we were hacked and this did not actually happen, which is a huge embarrassment. And then the day after that, having to approve the ETF that they were planning on approving, it was a fiasco for the department. So unsurprisingly, they are pressing charges, and I assume will not hold back against this case. And I don't know how long it took for them to locate and figure out who did it and arrest them, but apparently the arrest took 10 months or 9 months. I'm curious how long it took to figure out that it was allegedly Eric Council Jr. So wrapping up that story full circle, I remember in January saying, when we find out who did it, I'll bring it up. So we have that answered. Oh, jumped ahead, sorry. The final notable event from October was the announcement that, it was on October 7th, the announcement that FTX received court approval of its bankruptcy plan that would allow it to, I need to do air quotes here, fully repay its customers using, it was $16.5 billion in assets that the I forget what you call them, but the person that is overseeing the Chapter 11 bankruptcy, I guess, is a professional bankruptcy attorney, accountant. I don't know his exact title, but the people that ran FTX no longer run FTX. They're either in jail or unemployed. So this person is the one that's filing with the courts, and was able to recover 16.5 billion from various sources, from the hedge fund, from the custody business, from different assets like the Bahamas apartments that the co-founders had bought, various donations that they made to charities, and venture capital investments that they made. One of the biggest one was being in a company called Anthropic, which is an AI startup that actually I think they doubled their money on. So it was like, out of everything that they did, like that was actually a good investment that ended up leading to a somewhat good outcome. But what I wanted to bring up here was that if you read the headline here, is 118% refund plan. So it's going to pay 118% of the assets that clients who held on the exchange had that they lost due to the fraud and the scam associated with FTX. So everyone that had $50,000 or less on the exchange, which was 98% of their customers. So that 2% that had a lot of money doesn't include them. But the majority of people who had, still probably their life savings, but only $50,000 of their life savings, they're going to get their full 100% of their money back, plus 9% per year, so 18% in lost interest. However, that money was dated November, let me get the date right here, November 11th, 2022, when FTX originally filed bankruptcy. So for those of you that follow the crypto markets, that was the bottom of the market for cryptocurrencies, mostly because FTX was this bastion in the industry. And when they filed for bankruptcy, there was a fear that the crypto everything would go to zero, and that it was all a scam, and that there was no underlying value, or no one wanted to do it anymore. So it was the bottom. So these assets, the amount that needed to be repaid, was priced at the bottom of the market. So Bitcoin was valued at $16,800 approximately on that day. Today, Bitcoin is $75,600, which is a 350% gain over 2 years, which I think is better than NVIDIA. So when you're saying you're recovering all of the assets that were lost, and not only all, is 118% of the assets were lost. It sounds good on paper, but essentially all the people that had money on the exchange were forced to sell their holdings at the bottom of the market. Now, it's nice that they're getting some of their money back instead of getting zero, which was the expectation that a lot of people had, but still not that ideal. With that said, personal behavior is difficult to follow because not all of the holdings on the exchange were Bitcoin. Some of them were other crypto projects that did go to zero. And some people probably would have sold at the bottom anyway, or would have sold at different times. So it's not guaranteed that every person on it would have that 300%, 350% gain by holding all the way through. Some of them didn't have Bitcoin, and some of them wouldn't have held that long. So whether or not this 118% return on this fraud, this classic massive financial scandal that will be in the history books, is a good outcome, that is subjective. And I assume it depends on who you ask. If you ask someone on the street that had nothing to do with it, they probably would say, I don't care. And if you ask someone that lost out on their money, they probably say that's not enough. If you ask the, Sam Bankman-Fried, who's pictured there, who's in jail, he has claimed and has filed court appeals saying, see, all the money was there. There was no fraud, 118%, which, is not fully true, as I explained, but he's trying to get out of prison. It's like, if the money is there, there was no fraud. Now, again, not true, but somewhat of a compelling argument, especially for those that just read the headlines. All right. So hopefully you followed me on all four of those news headlines. Hopefully it was interesting to all of you. Let's briefly talk about the election. I don't have that much to say. This isn't a political webinar. This is talking about the financial markets, and I had preempted some of what I was going to say in the earlier slides, where the markets took off today. Depending on the index and the Nasdaq, the S&P 500, GARP I think was up the most out of all of them. The growth at a reasonable price index was 4.5% for the day, which is the best return I've seen on that index since I started tracking it. Most of the others were up 2%. Some of them were 3%. I think small caps were 3-4% up in a single day. Like, clearly from a stock market standpoint, not from a personal belief standpoint, not from a long-term, will these economic assumptions turn into economic realities for Americans or the rest of the world. Just looking on today, the expectation is this is a good thing for the markets. Will this affect how I allocate money or recommend investments to people? I would say generally no. As I've mentioned in past elections and past coverage of this election or the expected upcoming election that is now passed, markets perform well under Democratic leaders and under Republican leaders. Historically, they perform the best under split houses, under split governing rule. So essentially, that just means is if there's a Republican in the White House and they don't hold all three chambers, essentially not that much can get done. And historically, markets perform the best when the status quo stays the same, because companies perform well when they can project what will happen, when they can understand the landscape and they can make the best decisions for themselves. Now, tax breaks can definitely help pump up their bottom line, but eventually, if you're taking a longer term view of like 40 years, eventually deficits come due and will cause problems later on. So it depends on your time horizon, but generally this shouldn't matter. It shouldn't affect performance of the markets in general. Talking about specific investments, specific securities, I might make some adjustments to the various holdings and various portfolios I have with clients. It's too soon to say. I want to review how the markets perform over the coming months, upcoming to the inauguration. I expect I'll make any adjustments, and if they are adjustments, they'll probably be slight when I make most of my rebalances in early January, which is normally scheduled for my portfolios. So that was covering changes to investment philosophy and such. The bigger change that I wanted to mention was changes to the financial planning landscape. So I've been going on for a while the assumption that there would likely be split Congress, and I did not expect Trump to win. That the Tax Cuts and Jobs Act, which was passed in 2017, which were the tax cuts that have affected many of my clients and most of America in some way or another. Various of those laws, which was not just tax cuts, but estate exclusions, various itemized rules for tax deductions, there were a myriad of changes in that law. My original assumption for many years was that will sunset in 2025 or 2026 rather. So you have it in 2024 and 2025, and then when 2026 comes around, it would revert back to how it was prior to 2017, which was how the law was written, because they couldn't get approval or enough members of Congress to pass a permanent bill. It was only be able to be 10 years or however many years was, 8 years. I forget. I think it was 8 years. So because of that, I want to hear what other financial planning industry experts and advisors have to say before I change any client plans. But there is a larger likelihood that there won't be a sunset since Trump has won the presidency and the Republicans have decidedly won the Senate. The only question outstanding is if they sweep the House as well. That's still unknown as of today, Wednesday. So we're going to have to see if there are further tax cuts. At least for the short term, many of my clients will benefit, depending on how the estate exclusions and such affect. That's for like estate planning and leaving money to children and charity. All of those strategies that we currently have with clients might be affected. So with that said, don't worry, anyone that's listening. I'm on it. I'll be keeping touch, keeping on top of it. And if anything material changes, I'll contact you. We'll discuss it our next annual review, and we'll make sure that whatever is in your best interest, we will do. But it's too soon to say. The laws haven't passed. He's not inaugurated yet. We don't know what the House is going to look like. But it's important to mention, like, some assumptions have changed now that Kamala Harris has lost. So hopefully this webinar was helpful for those that either wanted to hear about the markets or wanted reassurance that the stock market wouldn't crash or would continue to go up, or that if you wanted my 4 news items other than the presidency. Hopefully everyone got something out of this webinar. I'll definitely have more to say next month as I and everyone digests this somewhat upset, at least in my community, surprise. Now I'm in Maryland, is a rather liberal state. This surprise candidacy or victory by Donald Trump. So I hopefully will talk with all of you more next month, and hopefully I'll have continued good news, at least in the markets. It'd be great if this rally continues in a sustainable way. These large rallies very quickly aren't always sustainable. So hopefully it continues in a way that leads to continued wealth creation that doesn't get pulled back in a little bit. All right, that's the webinar for tonight. Thanks all for attending, and I'll see you guys all next month. Have a good one.